Welcome everyone to today's CFA Switzerland webinar on cash flows. My name is Niklas Bornitz. I am the co-chair of the Professional Learning Volunteer Committee at CFA Society Switzerland, and I'm thrilled to introduce a very interesting as well as hands-on topic. There are a couple of key takeaways from this webinar as well as further reading on those keen to learn deeper their knowledge in this area of financial analysis, so stay tuned. Cash is king, as the title says, and unlike many other financial elements affected by accrual-based accounting, which may involve judgment and hence potential for manipulation, there should be no such thing for cash flow. But is this right? We shall see in the next 60 minutes. Dr. Jacek Welc, and apologies for my bad pronunciation skills, is an assistant professor at Wroclaw University of Economics and lecturer in corporate finance at SRH, Berlin University of Applied Sciences. In his academic work, Jacek specializes in financial accounting quality with focus on reliability and comparability of published corporate financial reports. And one of these elements are cash flow statements. He published more than 30 research papers and presented his research findings regularly to a global audience, just like today. However, Jacek also brings a lot of practical, real-life experience gained as head of corporate finance department at Dexus Partners and at PKF Poland, an audit and consulting firm. Jacek now co-owns a consultancy specialized in corporate financial services rendered to companies listed on the Warsaw Stock Exchange. As mentioned, for those interested in learning more about Jacek's research, he recently published a book titled Reading Between the Lines of Corporate Financial Reports in Search of Financial Misstatements. I will paste the book title in the chat in a few minutes. So we're excited to have Jacek today for this webinar, and I know that Jacek would prefer to have come to Switzerland as he's also an avid mountain hiker. And before I hand over to Jacek, let me remind you of our upcoming webinar with Victor Lee from the Expo Group on how M&A can shape a company's strategy, and in particular on Expo's shift from a traditional power producer to a recognizable renewable energy player. Now for the webinar, please use the Q&A functionality for questions, and we will deal with as many questions as we can towards the end of the session. There will also be a very short survey for which we will share a link in a few minutes. It's very important for us and to get to know what you want to hear from us and learn in the future. That is all from my side. Jacek, the floor is yours.
Okay, thank you so much, Nicolas. So welcome everyone. I'm very glad to have this short webinar to share with all of you my experiences and some real-life examples about the distortions, selected distortions of reported cash flows. Let me first just give me a few seconds. I'm going to share my slide set with you. Just a second. Okay. I hope this works now. Yeah, so the slide set is related directly to the subject of my today's webinar. Cash is king, but sometimes the emperor has no clothes. As an introduction, I just want to mention that there may be several more factors which may distort reported corporate cash flows, more than those which will be exemplified here. But generally, those groups, all those factors may be grouped into two classes of distorting factors. First, there may be distortions caused by objective weaknesses of accounting methods. For instance, the distorting impact of non-controlling interests on consolidated reported cash flows is one of such factors, with no any bad intention or no any misbehavior on the given company's managers or accountants or both. There may be still serious distortions. And they are unavoidable, but it's always good to be, as an analyst, credit risk or equity analyst is always, or just stock investor, is always good to be aware of such possible distortions. And the second group of distortions is more dangerous, typically, because this is driven by or caused by fraudulent behavior. like fraudulent recognition of corporate revenues in correspondence with manipulation or falsification of reported cash balances. So this is very important to be aware that all those factors which we'll discuss may be grouped into those two classes, both objective distortions as well as deliberate manipulations of accounting numbers, including reported cash flows. The old myth in corporate finance and financial statement analysis is that while accounting profits as reported in income statement is just an accountant's opinion, suggesting that they may be easily manipulated with the plethora of techniques, cash is king in the sense that this is immune to manipulations, but this is not entirely true. It is indeed true that cash flows are more immune to manipulations, but it's not true that they are entirely immune and resistant to some distortions. And here on this first slide, there's a list of several factors that I would like to exemplify today with real-life data. Let me start with the observation, which is obvious to many financial statement users, but also which is confirmed by my own research, not only academic research, but also my observation of real-life data of multiple companies. It is not uncommon for bankrupt firms, as well as for those which commit a financial accounting fraud, to report cash flows which are seemingly consistent with accounting earnings. And those several distortions that I will illustrate today will start with the relatively recent. That's why I'm going to start with this relatively recent but quite spectacular example of German company Wirecard AG, in which case it was detected and so far already, I think, confirmed that the company falsified its reported cash balances, consolidated cash balances, amounting to as much as 1.9 billion as at the end of the first half of 2019 or the end of 2019, I don't remember, but just before its collapse, the company was allegedly inflating its cash balances, consolidated cash balances, by almost 2 billion. And here you can see several data accounting numbers extracted from the company's consolidated financial statements, extracted from the company's annual reports as well as semi-annual reports. And what we can see here, let's start with income statement and balance sheet data. What we can see here is the company that appears like growing business, increasing revenues from every period to period. In tune with those rising revenues, we had operating earnings growing in tune, and earnings after tax also rising in all those periods shown in the table. And then what we can see is the the single line item extracted from the company's consolidated balance sheet, which is cash and cash equivalents. And what could have been seen was that the company's reported cash balances grew very steadily, so the company looked like cash cow until the end of the first half of 2019, when it reported accumulated cash balances allegedly amounting to over 3 billion. And now we know that out of the alleged amount of 3 billion of consolidated cash balances, as much as 1.9 has turned out to be fake. No more than and no less than just non-existent. So obviously, in light of the company's reported cash, in this light, the company's reported cash flow statements had no any touch with reality. Why? Because of the double booking entry principle in accounting. It is not the case that only cash balances could have been manipulated with other items of the primary financial statements intact. But in this very case, the company, this overstatement of cash balances was corresponding to the overstatement of its reported revenues and operating profits, because the accounting gimmick used by the company to inflate its results, to make the company looking more sexy than it actually was, so to speak, was to recognize revenues, fictitious revenues from the sales transactions which were completely fictional, fabricated. And unlike most other cases of fabricated revenues, falsified revenues, most of such cases, other cases, are done in correspondence with inflated receivable accounts. This is just by issuing invoices with different payment terms, which are never collected, because that's a substance of artificial sales transaction. Wirecard seem to step one step forward by pretending that its fabricated revenues have been collected already and accumulated in cash and cash equivalents, of which almost 2/3 turned out to be non-existent. So as a result of this, also the company's operating cash flows must have been inflated. And as we can see here, in all those periods, the company seemed like enjoying operating earnings entirely covered by its operating cash flows. So one of the metrics of earnings quality, which is comparison of the amounts as well as pace of growth of operating accounting earnings as reported in income statement with real operating cash flows as reported in the cash flow statement, that tool of earnings quality evaluation would completely collapse here. Because as we could see, in all those periods, except for the first half of 2019, that's the only exception just at the end of this time series of data, the company's operating cash flows more than exceeded its reported operating earnings. But it turned out to be exactly the confirmation that cash is sometimes a king who stays without clothes, because it turns out that most of those operating cash flows had no any touch with reality. So that's the first issue about to be aware of, that cash flow statement may completely lose its usefulness and reliability when cash balances themselves are falsified, because what you can see in the reported in the operating cash flows may have no any touch with economic reality. Let me switch to another example. Another distorting factor negatively affecting the comparability, intercompany or intertemporal comparability and reliability of reported cash flows are spurious improvements in operating cash flows of shrinking businesses, very often just before the collapse. And the example to illustrate it here is Claire's Stores. That's as US-based, as far as I remember, chain of department stores, which filed for a bankruptcy in early 2018. So let's see what happened in the several periods before, just prior to the company's default. What we could see first, when we look at the income statement data, that the company was, at least according to its reported data, it was profitable in those 2013 until 2015 fiscal years, with eroding earnings, constantly eroding earnings, both on the operating income as well as EBITDA level. Then it fell into negative territories on operating income level. And operating cash flows in all those periods were lagging behind reported operating income. Except for the last fiscal year. The fiscal year ended January 28, 2017, because the company had fiscal years starting in early February and ending at the end of January, typically, those 12 months. There was sudden, not very impressive, but some improvement, alleged or seeming improvement in operating cash flows, because in this very last period, when the company reported negative operating income and even negative EBITDA, it looked like increasing its operating cash flows after their negative amount in the prior fiscal year to plus $8 million. But what we could have seen was that it was entirely attributable to a positive contribution by almost $20 million from change in inventories, so from the reduction of inventories, which itself was nothing bad, of course, because the company, which suffered from excess inventories that accumulated from prior periods, poor demand forecasting or poor collections management or whatever. Anyway, they had an excess of inventories. stockpile inventories. So shortly before the bankruptcy, the company tried to support its constantly worsening financial liquidity. So the priority was to boost financial liquidity by aggressive liquidations of inventories at deeply discounted prices. So just to get rid of more inventories, to bring their level, stockpile level, to more normal levels, the company deeply cut its prices, and that's why its margins collapsed. But the opposite or related impact was a huge boost, temporary boost, which was unsustainable to its operating cash flows. That was unsustainable because this reduction of inventories did not reflect a real improvement in the company's efficiency in inventory management, but just clearing the house by dropping all redundant excessive inventories. And that was just purely one-off boost to operating cash flows. So this is very, very important to be aware that many companies which are contracting, which are less and less profitable, and which burn more and more money on operating cash flows, sometimes they report spurious improvement just before their final ultimate collapse or the loss of financial liquidity. Okay, then something which is less obvious, the third factor which I wanted to discuss today is a significant non-controlling interest. The non-controlling interests reflect before earlier on they were labeled also as minority interest, and some companies still use this label for this. But according to IFRS, officially they are now labeled as non-controlling interests. And these are interests of shareholders other than the parent company in the equity of the parent subsidiary. So here you can see the simple structure of just two companies. That's a group of French companies, Rallier. I don't know if the French pronunciation for this, but let's call it Rallier, which filed for a bankruptcy in May 2019, and its major subsidiary, not the only one, but major subsidiary, Casino Group. And again, this is the chain of FMCG retailers, mostly supermarkets as far as I know, which lost its liquidity in May 2019. And Casino Group itself operated through a chain of lower level in the group of companies, lower level subsidiaries. But what we could have seen here is that Rallier, which was a parent company listed on the stock exchange, Casino Group was listed too, the major subsidiary, and Casino Group was a subsidiary, or is still a subsidiary, controlled entity, so-called non-wholly owned subsidiary, because Rallier, the parent, holds 52.1% share in the equity of Casino Group as at the end of 2018, and somewhat less, 51% at the end of 2017. So more or less, somewhat more than 50% of equity interest in its main subsidiary. So obviously, Rallier controlled Casino Group. But according to the consolidation, financial statement consolidation principles under IFRS, the results, including cash flows of the subsidiary, are fully consolidated with the results, respective results of its parent, 100% consolidation, regardless of the actual share of the parent in the subsidiary's equity. So what you can see here, we can see consolidated cash flows of Rallier first, extracted from its consolidated financial statements, and constantly positive operating cash flows in all those 5 fiscal years prior to the company's bankruptcy. And then we can see beneath, in the lower part of the table, consolidated cash flows of Casino Group, Rallier's major subsidiary. And here also we can see the consolidated cash flows were positive in all those periods. But what is more striking is that virtually entire operating cash flows as reported by Rallier, consolidated cash flows reported by Rallier, were 100%, almost 100% attributable to its major Casino Group, major subsidiary, despite the fact that Rallier, the parent, could participate, at least legally, in only slightly more than 50%, half of those operating cash flows reported by the main subsidiary. That's very important for heavily indebted companies because this is not uncommon that the parent on the top of the group, the ladder of the company, of the companies within a group, the rallier or the parent company is heavily indebted because that's the one which issues corporate bonds on global capital markets and then drops the borrowed funds to its subsidiaries, while operating cash flows are often generated on the lower levels in the group structure. In such a case, if you calculate the ratios like coverage of consolidated debts, which mostly stay on the lower part of the group at the parent level, and you compute the coverage of such debts, borrowings by the cash flows, consolidated cash flows, which in contrast are generated on the lower levels in the group structure, then you may obtain completely distorted findings about the company's liquidity and financial standing because significant part of those consolidated cash flows as reported by the parent are not attributable to it. And nowhere in the cash flow statement you will find a breakdown of cash flows into their part attributable to the parent versus the part attributable to non-controlling interest. Unlike in income statement and balance sheet, when there is some information, some breakdown about items attributable to parent and non-controlling interest, no equivalent breakdown is offered by a cash flow statement as prepared under both IFRS and US GAAP. Okay, let me switch to another example. Another distorting factor, potentially distorting factor, is capitalized intangible assets, and that's this is going to be illustrated by the case of Starbreeze AB. That was a Swedish video game studio, developer of video games, which filed for a bankruptcy in late 2018. So let's check what could have been seen in its annual reports in the preceding 3 fiscal years. In the balance sheet, we could see total assets rising fast, and we could also see significant share in those total assets, not only significant share, but also fast pace of growth of the item labeled as capitalized expenditure for games and technology development. In other words, the company worked, meaning spent more and more on developing its video games, work in progress video games, not only games which were already commercialized, but then they were updated, but just new titles. So as we can see, they spent a lot of money on that, rising amounts. This is expressed in millions of Swedish crowns. And the thing is that when the company spends on development on new intangible assets, such expenditures may be, depending on the accounting policy of the particular company and also the time frame, the framework of the effective accounting standards, such expenditures may be either expensed as incurred or capitalized on the balance sheet. When they are capitalized on the balance sheet, the profit is increased because they are first capitalized. Such expenditures are first landing on the balance sheet, and only then they are amortized through time instead of being expensed as incurred. But the side effect of such capitalization is also that such expenditures are reported in the cash flow statement in the investing section. Investing cash flows of this company, as we can see, were deeply negative to a large extent due to investment in capitalized expenditure for games and technology development costs, which depressed investing cash flows, which also meant that they inflated completely legally, because that was consistent with IFRS, but that was still distorting, because the company, which seemed like, particularly in 2015 and 2016, which seemed like being able to generate some positive operating cash flows, even if not impressive, at least positive, that was to a large extent because it capitalized huge amounts on its balance sheet. If, in contrast, the company expensed all its expenditures for games and technology development as incurred, then operating cash flows, which we can see here, the reported operating cash flows would be lower by those amounts which we can see in this line marked by red. So they would be deeply negative instead of positive. That's very important because when we talk about relatively small company, small R&D intensive company, so to speak, intangibles intensive company, which operates in the so-called hit or miss business. You create a video game and it will be a huge hit, or complete miss, which means that when you commercialize the title, it is not able to bring you any money. So in such hit or miss businesses, if those games or those work in progress, the technology projects, games or other titles or music titles, films, etc., if they fail, then of course they may be worthless and the value in the balance sheet may represent nothing. And the byproduct of this may be huge distortions of the reported cash flows, operating cash flows, because they are inflated by the transfer of such intangibles driven expenditures into investing section of reported cash flows. Okay, another factor to be aware of is various treatment, something which is not strictly regulated under IFRS, as far as I know, at least it wasn't before, is customer financing schemes. Let's see the interesting case of Volkswagen Group, the consolidated data of Volkswagen Group, who restated its cash flow statement reported for fiscal year 2008. So the crisis year, for those of you who remember what happened 12 years ago. And in this table, we have several extracts from the company's cash flow statements for 2008, for a single year only. That's for the fiscal year 2008, but data reported in 2 consecutive annual reports. First, what we could have seen in the annual report for 2008 was operating cash flows totaling 10.8 billion after rounding, and deeply negative investing cash flows of almost minus 20 billion. So the company appeared like investing a lot, but generally being able to turn it quickly into its positive operating cash flows. But 1 year later, in the annual report for 2009, and as we know, in the annual report for 2009, there were also data for the preceding year, comparative data for 2008 reported, the same cash flow statement for the same 2008 looked completely different, because no longer in the annual report for 2000, in the cash flow statement with the data for 2008, you no longer could see almost 11 billion of operating cash flows, but just 2.7. Instead, investing cash flows were not as negative as before, which means that there was some reclassification of some items. And indeed, what we could see here is that until 2008, Volkswagen treated its sales boosting, that's important, sales boosting loans granted to customers and car dealers too. So when we buy the car, right, we know that we can get some like 50% payment now and 50% later on. So this is like a loan granted to customer. And the same is offered to car dealers by Volkswagen Group. So until 2008, Volkswagen treated such sales boosting loans as well as investments on lease assets, their own cars, which they gave to the customers under lease contracts rather than sale transactions. Instead of buying car, we can lease it, right? So as users of the car. From the company's perspective, those cars were still their own. The legal ownership still remained with Volkswagen. And the company treated such investments on lease assets as investing cash flows. That's why in the investing section, we could have seen 2 items like change in financial services receivables, -5, and change in leasing and rental assets, -3, so totaling -8, which have been reclassified later on to operating section with some adjustments to the numbers also. So the numbers do not match precisely, but more or less what we can conclude from here is that what the company treated as non-operating, now they started treating as purely operating, because that was nothing more and nothing less than incentives to boost sales, granting financial loans to customers, as well as effectively selling some assets, some cars under lease contracts rather than sales transactions. But we can see that such reclassification had a huge impact on the company's reported cash flows, which no longer look that high as before for the same year and for the same company, remember. And okay, another distorting, very important factor to be aware of, particularly in case of so-called takeover intensive businesses, those companies which tend to grow by swallowing other companies, it's their competitors or other businesses, whatever. If we talk about companies which are serial acquirers, acquire more and more and more, a lot of new subsidiaries, or those who are not serial acquirers, but only from time to time acquire other company, but those acquisitions are significant, then we have to be aware that cash flows may be distorted as well. Why? Let's see the real life example of the company named Conviviality, which, as far as I know, filed for bankruptcy. That's the company which was listed or is still listed on the London Stock Exchange. I don't know if they filed for bankruptcy, but I know that they had huge financial troubles a few years ago. To a large extent attributable to the acquisition of series of acquisitions, including the main acquisition, the largest one, which was the takeover of the company named Matthew Clark. And these are the companies are retailers of some consumer goods. As far as I remember, that was soft drinks or alcoholic drinks. And that takeover was closed in fiscal year ended May 1, 2016. And what we could see there in the consolidated cash flow statement of Conviviality PLC, as reported by the company in its annual report, was consolidated operating cash flows, consolidated cash flows amounting to plus 21.8 billions of British pounds. But then in the same cash flow statement, we could see change in working capital, inventories, receivables, and minus payables, increase in working capital by just 1.8. So that 1.8 was part of those positive consolidated operating cash flows. So it could have seemed that despite an increase of its working capital by approximately 1.8 billion British pounds, the company enjoyed still positive consolidated operating cash flows. But then when you looked into the company's consolidated balance sheet and computed the change period to period, year end to year end, change in consolidated working capital from the balance sheet, not from the cash flow statement, then you could see that actually the amount of working capital increased by as much as almost 32 billion, not just less than 2 billion British pounds. Why? Because that difference, which is calculated here, this discrepancy between changes in working capital as reported in cash flow statement versus balance sheet, was attributable to the working capital, mostly inventories, a lot of inventories of its new subsidiary acquired as part of this business combination, as part of this takeover. The thing is that under most accounting standards, or all accounting standards that I know, any investments in equity shares in other companies are reported as investing cash outflows, even in the hypothetical scenario in which the company acquires a new subsidiary, which is nothing more than just inventories. Even if you imagine the company, the new subsidiary taken over, which has no other assets and no other liabilities, nothing more than inventories in its balance sheet. So effectively, such transaction is the purchase of inventories from the cash management perspective. Under accounting standards, such expenditure or on such inventory intensive, so to speak, subsidiary is reported as investing cash outflow. So when we adjust those consolidated operating cash flows for the gap, for the discrepancy between change in working capital as reported in cash flow statement versus balance sheet, then no longer Conviviality appears as cash generator, but it appears as the company which on its core business operations, so cash flow stripped out from the effect of major takeover, they turn out to be negative at minus 8 billion British pounds. So this is also something which is very important to be aware, particularly in case of serious acquirers. And the last case study, last example for today is also quite a recent case of the clearly COVID-driven, but not only COVID-driven bankruptcy. That's the bankruptcy of Norwegian Air Shuttle, the low-cost airline, the first airline which attempted to launch low-cost transatlantic flights between Europe and US. And it filed for bankruptcy in November 2020, so quite like a few weeks ago. And then when you extract from its most recent annual report, so from the annual report for fiscal year 2019, when you extract several data from its cash flow statement, you would see that, and you just blindly, mechanically look at the trend of reported operating cash flows, you can see that operating cash flows allegedly increased from that amount, less than half billion of Norwegian crowns, to something like plus 3.037.8 billion crowns. So improving cash flows of the financially troubling company. But then when you dig more in the between the lines of its annual report, you would find that this is purely attributable to the change in accounting principles applied by the company as a consequence of the change of accounting standard related to lease accounting. No longer IAS, International Accounting Standard 17, past no longer effective standard related to accounting for leases is applicable, but the company still published its data for fiscal 2018 under old standard, while in the same annual report, the data for the most recent fiscal year for 2019 were already reported under the new standard IFRS 16, in which lease obligations are capitalized on the balance sheet. But it means that principal repayments of lease liabilities are no longer reported as negative contributors to operating cash flows as they used to be under the old, no longer effective standard. But instead now the principal repayments of lease liabilities are reported as financing cash outflows. So this means that if you make a simple adjustment of those reported data for 2019 by subtracting from reported operating cash flows of this amount what is reported much lower in the cash flow statement in the financial activities section by minus 3,923, then the company would appear to suffer from the collapse of those positive cash flows, operating cash flows, to minus 900 something, instead of improving its cash flows to much higher level than before. So this increase, alleged or seeming increase of operating cash flows, was purely attributable to the prospective only application of the new accounting standard without any adjustments to the previously reported data for 2018, which was something which was absurd to me. That's the different story, but that was allowed by IFRS to apply this new standard only prospectively, which brought about a lot of distortions in financial statements of corporations apply IFRS. And that's it for this short webinar. Just wanted to infect you with some awareness of the possible distortions. This is not an exhaustive list, but I just wanted to make those of you who were not aware of such possible distortions to just know that cash flow is only more immune to distortions than income statement, but not entirely immune to sometimes dramatic distortions. Okay, so thank you. I'm gonna stop sharing my screen. So let's now proceed to Q&A session.
Thank you, Jacek. I think one of the key takeaways here was not only to look at operating cash flows bottom line, but also the split in other items in financing as well as investing cash flows. And furthermore, consolidation of not fully held subsidiaries may be absolutely misleading. So watch out when looking at consolidated cash flows.
Yeah, definitely.
One question we received before the session was how do you proceed in your analysis of cash flows? Do you start, for example, with the net income and then build your own cash flow statement based on the indirect method? Or what's your way? How did you came up with all these findings in your case studies?
Okay, so when I proceed to any analysis of any annual report, I start with just printing it and reading all of this in details, including narratives, like, you know, those explanations of the principal accounting principles, main accounting principles, etc., and also some details of some transactions, so that they open my mind to possible distortions, which, with this awareness, then after this reading, that some numbers could have been distorted deliberately or undeliberately, as we know already, then I know when, after proceeding in the later stage to investigating the numbers themselves, I am aware which of them could have been distorted. So this is just, I start from the reading details of narratives, explanation of transactions, etc., etc., and only with this knowledge I investigate the numbers. Because, for instance, to be aware that that very distortion that Nicolas mentioned, distortion due to non-controlling interest, you can know this only when you read like the section related to business takeovers done in a reported period, in which you can read in sometimes just one sentence in narratives that we acquired 52% controlling stake by paying this and this. And then you know that they have significant non-controlling interest. And with this awareness, it is much easier, or you can more reliably investigate the numbers. So first is the reading of what happened to the company and what accounting principles they apply.
And is there any preferred KPIs you look at? Putting cash flow in context to, as I think one of the first case studies, put into context with operating income?
It depends on the business. In terms of the individual numbers, okay, it depends also if we talk about searching for the distortions or searching for the further step of analysis like valuation or credit risk analysis. But if we are still talking about distortions, depending on the business model of the company, when I know the business model, I know where typically the distortions may be located. Like if this is the company which is heavily R&D intensive, then I'm just reading about the treatment of expenditures on R&D, so that I know that this is the area through which the channel through which operating cash flows may be inflated, even undeliberately, or at least uncomparable between companies. Because let's imagine that you want to compare, or you want to do a relative valuation of Samsung versus Apple. No any dishonest behavior there. I got no idea at least about any such. But still there will be no comparability of cash flows, because Apple reporting under US GAAP, they expense most R&D as expensed, with very, very minor exceptions. Samsung, applying IFRS, have a more leeway to capitalize its development expenditures, expensing its research, but capitalizing development expenditures. The same Airbus versus Boeing. The same, I don't know, Bayer versus Johnson & Johnson or Pfizer. So depending on the industry and business model, with the experience, self-proclaimed experience that I have, so to speak, I just know which areas may be crucial in this particular company, while others may not be that relevant, this kind of issues.
Okay, and then two specific questions, one on energy and resources and one on agriculture. First question, do you see any distortions possibilities with regards to cash flow hedge accounting? For example, in utilities, margin calls?
Hedge accounting, you mean derivatives, like forward contracts, etc., right?
Yes, if you apply, if you can do hedge accounting, if you can prove it's effective.
Yeah, I think so. But I have to check, because this is just my fresh. I'm improvising now. But what I would pay attention to is that some companies, if they prove that the hedge accounting is effective, they often report also in the income statement. They often report gains and losses from realized or no longer effective hedges in the operating section of the income statement, and such no longer effective, or at the beginning ineffective hedges reported, because when this is proven that this is reported to core business operations, they are also part of operating cash flows if they entailed already cash inflows or outflows. In contrast, those who allegedly unrelated to operating activities, like hedges related to borrowings denominated in foreign currencies, for instance, they are reported in investing typically section or financing section. I would have to check. So I think that some reclassifications or treatment, the same like interest costs. Some companies treat interest costs as part of financing activities, which is, in my opinion, closer to the economic substance of them, while others report interest costs and even dividend received from equity accounted subsidiaries as part of operating cash flows. So this kind of reclassifications, I think, is some room, perhaps not the only one, when hedge accounting may cause at least some comparability distortions. If not reliability, then at least comparability distortions. But I would have to dig deeper. But I think this kind of issues may be distorting here.
Yeah, the person who asked the question didn't leave a name, but you posted your email address, so if there's more interest, then we can follow up on that.
Sure. Feel free to contact me by email, of course.
Great. Then the question, your views on accounting for crops which are not yet harvested and how they impact EBITDA and the cash flow statement. Also very quite technical.
Yeah, I don't, to be honest, I don't remember if that accounting standard changed, because that's very niche area of accounting, but there was the accounting standard related, IFRS standard related to biological assets, in which they could have been reported at fair value. So as the forest, so to speak, or the grain matures, this is revalued to fair value, while in many cases fair value is based on expected discounted cash flows. That's one of the critics of one of the reasons for the critique of this approach in US, because in US GAAP do not allow for such cash flow valuation based reflection of, and then the gains and losses from such revaluations, they are reported as gains and losses in the income statement. But these are non-cash gains and losses. So I think from the cash flow perspective, they probably do not distort a lot. I would have to think twice about it, but because this is purely fair value revaluation, as long as the crop is not ready to be sold, this is something which may boost reported earnings, but which is signaled by lagging, but cash flows which are lagging behind, I guess. So probably, I emphasize the term probably at the moment, probably no serious distortions of cash flow statement from this area. But again, if you know any possible distortions, feel free to contact me and I will be happy via email. I'll be happy to get deeper into this.
To adopt it in as one of your case studies. And then another question following a takeover. How to treat a company whose balance sheet is mainly comprised of goodwill and intangibles due to a recent acquisition? When looking at the cash flow, there are important non-cash adjustments, hence generating high positive operating cash flow, while net profit of the company is very low, could be very low.
So, okay, so I would have to just see the specific case because those adjustments, there may be many adjustments. If the profit is relatively low, and then it is operating cash flows tend to appear to be much significantly higher than reported net earnings. Probably this is due to some provisions or this kind of non-cash charges to earnings. I don't know if in this particular case, which the question refers to, if this is related to business combination, because typically in business combinations, all the provisions, revaluations of assets are done immediately on 0 day, so to speak, on the acquisition day. So this is business combinations booking entries. But also there may be some post takeover write-downs, which may depress profits without cash outflows. But there will be, I think there will be a lot of factors. If the question comes from someone who has the particular company in mind, which is not confidential, if this is public company listed, please feel free to contact me with its annual report. I will be glad to see that, because there will be many adjustments responsible for this, for such gap between relatively subdued earnings and much more impressive, at least on the first side, cash flows.
Yeah. Then question from Alan Overwell. Thanks you for the interesting presentation. And you discussed mainly operating cash flows. Do you think that most of the issues you mentioned will be solved if investors were to look more on free cash flows instead of just operating cash flows?
Yes, some of them, yes. Not all, but some of them. If we come back to the Wirecard case, obviously not, because when cash was inflated, then everything, the entire cash flow statement is a piece of, you know. If we talk about such distortions which relate to the transfers of some cash flows between sections, then yes, the investigation, the detailed investigation of the entire cash flow statement may be very, very valuable. For example, in Starbreeze case, that video game developer, if you calculated free cash flows by subtracting from operating cash flows, subtracting those capitalized expenditures on capitalized development games, then the picture would look completely different. And I agree that when looking, the devil sits in details. So when looking into the details may offer you a lot of insights. Just let me give you, if this question came, sometimes this is even single item, which was maybe very enigmatic at the very first sight, but may open your eyes to, or at least just incentivize you to much deeper investigation. For instance, let's imagine that the company A acquires controlling stake in company B by buying, say, 60% of company B shares. And then they have an agreement, perhaps even with some earnout clause or without it, that the remaining 40% may be purchased in next quarter, for instance. And from the cash flow perspective, this very first transaction, that transaction which gives control is reported under as investing cash outflow. But the other one, the purchase of remaining 40%, even though this is related to the same business acquisition, because in effect you collect 100% of equity stake, this remaining transaction is only treated as transaction with non-controlling interests, because effectively you purchased from non-controlling shareholders of your new subsidiary the remaining stake. And such outflow is reported as financing cash outflow, no longer investing. This is treated also in equity in the balance sheet, is treated as transaction between non-controlling interest and you. And this is important. You know why? Because when you calculate goodwill, goodwill is calculated only on the basis of the initial transaction when you got control. So if you structure the transaction, if only you have friendly previous owners of this new subsidiary, let's suppose that you agreed to buy 100% share for 100 million. If you arrange this somehow, that the first 60% will be purchased for, say, 20 million, and the remaining 40% for 80, and you dress it in legal documents, you know, to defend it, then not only cash flows will be distorted, but also goodwill and many other items on the balance sheet may be in an income statement may be distorted too. So that's very important, because sometimes such splits of business takeovers or demergers in other direction, because when you lose control, but you do not sell the entire stake in your previous subsidiary, then again another booking entries are needed, and the line by line reading of the entire full-blown cash flow statement may open your eyes into something which is not immediately seen in the income statement and balance sheet. Some items like which contribute positively or negatively, but significantly, like gains on the loss of control in the previous subsidiary, something like this, which should open your mind to dig deeper into this. So I do encourage to read the entire cash flow statement with a lot of details, and anything which is strange and anything which you don't understand which you don't understand there by the name of the item or something which is significant, please do not treat it as something which you don't understand because you are not skillful enough, but please treat it as something which is potentially deliberate arrangement which could have been designed to distort the entire financial report.
And then one last question. You mentioned differences between US GAAP and IFRS. Do you think there's any international recognized accounting standard that gives you more clarity or is less prone to manipulation or distortions? And second question, recent changes in IFRS, have they helped to shape up and give more clarity in cash flow statements?
Okay, so the first question, if we compare US GAAP to IFRS, first, I am not specialist in US GAAP with details. I did work with US GAAP data. One of the projects that I did several years ago there in US was for the one US Pennsylvania-based company, which was, of course, obviously using US GAAP. They transformed their financial statements to IFRS because they intended to be listed on one of EU stock exchanges. So that was for me also a nice experience because, you know, we dealt with US GAAP and we converted those statements to IFRS. I mean, me and my auditing colleagues. So my personal impression from reading of the annual reports of many US GAAP reporting companies is that US GAAP, in my opinion, is more immune to manipulations. Not entirely, of course, but more immune to manipulations. And IFRS, the load of subjective judgments in IFRS is much bigger. In the sense, like, there are many more clear-cut thresholds under US GAAP. Like, for instance, you treat something as your subsidiary once you exceed 50% or something. Not everyone does. There is such rule-based approach, but this is more rule-based approach as contrast to principle-based approach of IFRS, where many more areas, like even when you read the contents of the standards, there's more like in reasonable circumstances, something blah 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 can be done, and this is always you know, a room for trying to push the financial statements into the area of aggressive accounting because the borderlines are so, in my opinion, between the two, IFRS are more prone to manipulations. The very fact that we have fewer, this is my private opinion, the very fact that we have fewer spectacular accounting scandals under IFRS is, in my opinion, because of the much weaker position of any regulators in Europe or elsewhere as compared to US SEC. You know, even in EU, in entire Europe, not to mention entire Europe, but even within EU, we do not have a single regulator like SEC. This is regulated on the national level, right? So the position is much weaker, and I think that this is not the lower volume of accounting manipulations under IFRS, but this fewer is just detected, in my opinion. As regards other accounting standards, as far as I know, German accounting law, which is still applied by private companies in Germany, those who are not public, not listed on stock exchanges, etc., is very rule-based. So there are many more clear-cut, like you buy new car, new passenger car, so you should depreciate it for 4 years. That's it. You know, not like useful life estimates. So probably this is more immune, but on the other side, not always this is more resulting in more relevant information, because sometimes you depreciate for 4 years something which you can use for 10 years, right? So there is this trade-off between relevance and reliability there. And the second question was, if you remind me.
Well, there have been recent changes in IFRS that have helped to reduce the likelihood of this.
Yeah, I think that yeah, I can refer to IFRS 16 in that regard. I think this is correct that now leases are capitalized on balance sheet. It have been the very change itself was very welcome. This is only the way how it was allowed to be in that very transformation year, which was absurd to me, as I said. But the very fact that principal repayments of lease related borrowings, lease-driven borrowings, is reported as financing cash outflow is something which is closer to reality. As regards the other changes, to be honest, I don't know. I didn't track it that thoroughly recently. But what I learned from my analysis and also when writing my book is the very fact that something is, some reporting is consistent with the accounting standards, it's not the same that it is consistent with economic reality. So when reading the lines of any annual reports, I do not focus on trying to spot possible deviations from what accounting standards say, but I'm just analyzing them to point to find some possible weaknesses of reporting, which may be completely consistent, compliant with accounting standard, but still may result in some distortions. Like this distortion by business takeovers in conviviality's case. It is totally consistent with accounting standards. You invest in equity shares of any other business. This is investing cash outflow. But of course, that's deviation from reality if you acquire almost bankrupt company, which is not uncommon, so to speak. Because when I worked, just final example, when I worked for the consulting brokerage house here in Poland, we participated in many due diligence and valuation projects related to privatization of Polish zombie companies, previously state-owned zombie companies. So for the Ministry of Treasury in Poland. So there was a potential buyer, acquirer. They also did their own due diligence with one of big four companies, of some legal agency or whoever, but we were the partners for the ministry. And we saw a lot of almost bankrupt companies when there was no goodwill. It was just net assets and that's it. And within those net assets, intangibles are worthless at all. And sometimes this is almost in inventories that were there, almost. And in such a case, if the company acquires such a company, then of course this is investing cash outflow, but in reality, this is purchase of inventories. And I will just give you the final suggestion why to be careful about such transactions. Because we noted once, I cannot tell you the name of the transaction or whatever, or the name of the company, that the acquirer, the investor, sold its own obsolete inventory to the new subsidiary before the business combination date. So they got rid of obsolete inventories and they had reduction of inventories in their own cash flow statement before transaction. And then when they bought this new subsidiary, they bought all its net assets, including their own previous inventories. And because those inventories were impaired actually, so on business combination date, they just wrote them down to zero. If in contrast, they wrote them in their own books before, there would be a loss, right? So they sold them with profit to the new subsidiary, and even in cash. So they boosted their cash flows, pre-merger cash flows, while they regain control of those inventories on the transaction date. But on that transaction date, they have this time when they could write them down to zero without any negative impact on the. So any such transactions, like business combinations, significant business combinations with significant non-controlling interest, should always just open some, your awareness of possible distortions which might be there. But I mean not distortions in terms of inconsistency with accounting standards, but with economic reality.
Yeah, you need to do your due diligence.
Exactly.
So I think we close the Q&A here. Thank you, Jacek. I think there have been a couple of key takeaways that everyone can apply just by keeping an open mind, and don't get stuck if you don't understand something, and read through most of all, I think that's the key one, read through the entire cash flow statement and not just the bottom line, as well as the adjacent notes.
Yeah, exactly.
I would also like to thank the audience for their participation via the Q&A tool and questions sent prior to the session. The slides will be shared afterwards, and the session was also recorded in case you would like to review a section. And in terms of next step, you can see we pasted a link into the chat for our rapid feedback. So this obviously helps Jacek to better know what you should do more or less of in the future. And it also helps us, the Professional Learning Volunteer Committee at CFA Switzerland, of what events and webinars we should do in the future. So any feedback is welcome. And finally, please keep in mind our next event on direct investments in energy infrastructure by Victor Lehrer, Head of Asset Management at Axpo and former Head of M&A at Axpo. So thank you, Jacek. Thanks, everyone. Have a good day.
You're welcome. Thank you. Bye. Take